The U.S. housing market right now is confusing a lot of people. You're seeing headlines about crashes, about prices falling, about doom and gloom everywhere. But the reality is far more nuanced than a simple headline can capture. So let's walk through what's actually happening, piece by piece, and help you understand the forces at work. If you're trying to figure out whether to buy a home, rent, or just make sense of the market you're living in, this video is for you. And if you find this breakdown helpful, please subscribe to the channel so you don't miss future videos on money, real estate, and financial decision making. Let's start with mortgage rates, because they're the engine that drives almost everything in housing. When mortgage rates go up, the monthly payment you owe on a borrowed dollar goes up too. It sounds simple, but the psychology is profound. A couple years ago, rates were around 2 to 3%. You could borrow $300,000 and pay maybe $1,200 a month in principal and interest. Today, rates are hovering around 6 to 7%. That same $300,000 loan now costs you around $1,800 a month. That's a $600 difference every single month, or $7,200 a year. Now imagine you're a buyer looking at homes. Your salary hasn't changed. Your down payment savings haven't changed. But suddenly, you can only afford to borrow half as much money because your monthly payment ceiling is real. This is where buyer psychology enters the picture. People don't buy homes based on the price tag alone. They buy based on the monthly payment. And when rates go up, that payment jumps dramatically, even if home prices stay exactly the same. So buyers step back, they wait, they rent longer, they delay their purchase. And when millions of potential buyers do this at the same time, demand drops. But here's the thing about housing supply that most people miss. Homes don't disappear when demand drops. The house is still there. The owner still owns it. They might lower the asking price, or they might just keep it off the market and wait for rates to fall again. Supply is slow to respond to demand because houses are immobile, expensive to maintain, and often emotionally tied to the people who live in them. A lot of sellers won't sell at a loss if they can afford to wait. So supply stays relatively flat while demand crashes downward. That creates downward pressure on prices, yes, but it's not a dramatic avalanche-like collapse. It's more like air slowly leaking out of a balloon. This is why the crash headlines are so misleading. Real estate doesn't crash like the stock market can crash. A tech stock can lose 70% of its value in 6 months. Prices might decline 5 to 15% from their peak over the course of 18 months. That's meaningful for someone who bought at the absolute top, but it's not catastrophic. And for people who bought 3 years ago at lower rates, they're still sitting on significant gains. The median home price in this country is higher today than it was 5 years ago, despite all the recent price declines. That's not a crash. That's a correction within a longer uptrend. Here's another piece of the psychology puzzle. Fear of missing out, or FOMO, swings both directions. For the past 15 years, people have been told that real estate always goes up, that you're foolish not to own, that renting is throwing money away. Now, suddenly, the narrative flips. Headlines scream about crashes and disasters. First-time buyers get paralyzed. They think, maybe I should wait for prices to drop more. But here's the cruel part of that logic. If prices drop, it usually happens because rates dropped first. And if rates drop, you could have bought earlier at a higher price with a higher rate, or you wait and buy later at a lower price with a lower rate. The true cost isn't about what you paid, it's about the total amount you'll spend over the life of the loan, and that depends on the monthly payment you lock in, which is determined by both the price and the rate. So how do you actually think about this? The clearest way is to run a disciplined rent versus buy comparison, and I mean truly disciplined. First, be honest about your time horizon. If you're not staying in a place for at least 5 years, renting is probably smarter. The transaction costs of buying and selling a home are huge, often 5 to 10% of the purchase price when you add up realtor commissions, closing costs, inspections, and everything else. You need time for home appreciation and rent savings to overcome that friction. Next, calculate your true cost to buy. Don't just look at the purchase price. Get a current mortgage rate quote. Calculate the monthly principal and interest payment. Add property taxes, which vary wildly by location. Add homeowners insurance, which is rising in many markets. Add maintenance and repairs, which historically run about 1% of the home's value per year, though they're lumpy and unpredictable. Add HOA fees if they apply. Then compare that total monthly cost to what you'd pay in rent for a similar property in the same area. Be honest about the numbers. Don't assume appreciation. Don't count on luck. Look at what homes have actually done in your specific market over the past 10 years. Some markets appreciate steadily, others are flat, a few have declined. Your local market is unique. Then consider the non-financial factors. Do you want the freedom and flexibility of renting? Do you want to be tied to a home and a mortgage? Do you have unstable income that makes a fixed monthly payment risky? Are you planning to have kids, get married, change jobs, or move for a relationship? All of these things matter. Buying a home is not universally the right decision, despite what conventional wisdom says. Let's talk about where we might be heading. Mortgage rates are primarily set by the Federal Reserve and the bond market, not by politicians or home builders. Rates depend on inflation, economic growth, and where investors think interest rates should be in the future. The Fed is holding rates higher to fight inflation, which keeps mortgage rates elevated. If inflation comes down and stays down, rates could fall. Lower rates would bring more buyers back into the market. Demand would increase, and that downward pressure on prices would ease or reverse. But if inflation stays sticky, rates might stay high for longer. The path of rates over the next 2 to 3 years is genuinely uncertain. No one knows for sure. What we do know is that the housing market will not crash in a sudden dramatic way. It might continue to decline slowly. It might stabilize. It might start recovering. But it will move gradually, giving you time to think and make good decisions. The people who get hurt in housing are usually those who make emotional decisions, who buy at the peak without a real plan, or who stretch their budgets so thin that a job loss or emergency forces them to sell. The people who do well are those who have a long time horizon, who buy homes they can afford on their current income, and who don't obsess over price movements in the short term. Real estate is a stable asset for people who can think in decades, not quarters. So if you're considering buying, here's what I'd encourage. Run the rent versus buy numbers honestly. Factor in your personal situation. Talk to people you trust. Get pre-approved so you know your real financial capacity. And then make a decision based on data and your actual life, not on headlines or what your friends are doing. The best home for you is one that fits your budget, your timeline, and your life, regardless of what the market is doing. And if you found this explanation helpful, please like the video and let me know in the comments. Are you currently renting, thinking about buying, or already a homeowner? I'd love to hear what questions you have about your own situation. Thanks for watching, and please subscribe if you want more clear thinking about money and real life.